Hello, traders. Welcome to this live intraday strategy webinar on SB Trade Desk. Mike Boutros here with you this morning. We just got the release of initial jobless claims coming in slightly smaller than expected. That's a positive print here, 254,000 versus 269. That's off a previous upwardly revised from 268 to 270. So could see some dollar leveling off here from the pullback that we're seeing, but nothing too dramatic. Obviously, the ADP report was stronger than expected. That came out earlier, 8:15 this morning, 172,000 versus the 160 expected. So that puts us on track here for non-farm payrolls tomorrow. The consensus estimate has been at 180,000. We're still right around that region. Private sector payroll is somewhere in the region of 170. So obviously on the back of that 172 print we got, you're going to see a lot more expectations for a print of this magnitude. Heading into the release, we'll go over that later in the session, but heading into the release, the risk is really for a miss on the headline read. Not necessarily so much with the unemployment rate being at 4.8, because we did see that accompanying a move or a contraction in labor force participation, but certainly we'll go over these results in a little bit. Here's what the relative performance for the US dollar looks like heading into the US session. You have pretty much mixed performance. Kiwi with the biggest advance, up 1.16%. Absolutely went crazy. Kiwi went right through the weekly open, which was the bearish invalidation level, on some comments by Deputy Governor Spencer from the RBNZ, really warning about further rate cuts and how that could pose financial stability risks to the economy. So we'll go over Kiwi price action as well, but the short side of that trade, at least in my mind, near term, sort of been invalidated. Now, it's funny I say that because we're pulling off pretty sternly from the highs just now, but I'm not going to go chasing just yet. All right, let's get into the nitty gritty. If you have any questions or trade setups or specific pairs you guys want to throw out, do feel free. Premendra, great to see you in the room. Eileen, happy Thursday to you as well. Ricardo, Steven, Matt, Mark, Hussein, Graham, great to see you guys in the room. Pooja, as always. All right. So, first things first, here are the setups that we put out yesterday, and sort of where we want to focus heading into the non-farm payroll print, obviously, is going to be all the dollar crosses. So before we get started into the dollar majors, here's what the dollar index looks like, Dow Jones FXCM dollar index. We've been in this godforsaken zone now for a couple of days. You're basically right at where you open the month. So it's really not a very conviction trade here, at least for the index and where it stands in and of itself. Now remember, this specific index carries Euro, Aussie, Sterling, and Yen equally weighted at its inception. So with all the Sterling debacle that you're seeing, it's really skewing some of the clarity that we like to see here in the index. That being said, key levels to keep in mind have not changed. 11,965 is a support structure that we're looking at. You got the median line off the low, a basic 236 off the high, and that would necessitate a break below, again, the weekly open and monthly open. Key resistance, I'm going to move that still right around that region at 12,064. That's a key 618 retracement of the decline from the yearly high. So this is taking into account all of 2016 trade. And that coincides on the 50 line for the current operative structure right here. So you know the key levels for the dollar index. I don't think you necessarily have a play for the index in of itself, and most of the time we like to use this sort of gauge of base dollar movements. But as it stands right now, looking to see if we can get a stretch into that support. Ultimately, like we said, guys, earlier in the week, seasonalities do turn pretty bearish for the dollar. So we're kind of looking for a break below this to really validate some more near-term weakness moving forward. Any questions on the index before we jump into the majors? All right, here's euro dollar. And here's what we looked like yesterday. So the daily chart, I don't want to beat this up over and over again because we're essentially looking at the same exact setup, guys. Remember, the outside day reversal off of a critical resistance barrier earlier in the week shifted the focus to the downside. We continue to favor the downside while below essentially the weekly open. Now the weekly open lines up dead on with the 618 retracement of the decline. Here's what it looked like last night. And this was your bearish invalidation level. It just so happens that the slope off the low literally converged on that 50, and that was a beautiful opportunity to get short yesterday. Initial support 110.89, secondary support 110.60, and this is the break you need to validate the next leg lower. Not only would that 618 retracement validate a break back below the 50 line here that you're looking at, okay, but it would also give us a nice little break of the monthly open, test of the monthly open as resistance, and move off. So certainly for me, that's sort of the game plan moving forward. If you do get a chance to rally into that 618 today, I still think it warrants some possible short exposure on some near-term triggers. But if we do clear that 111.26, 111.30 zone, you want to be cautious about getting too aggressive on the euro, at least from a scalping standpoint. Here's what euro looks like now on the 30-minute. All right, so you can see, again, we came right into that confluence resistance last night, pulled right back. You actually got another opportunity as the market tested once again the monthly open here at 111.06, and then again a move to the downside as momentum held 60 as resistance. So I still think you want to keep that in mind. Like I said, you're likely to see the non-farm payroll lull start to kick in after the U.S. close today. Markets will tend to thin out. You'll get some real lackluster sideways price action as you head into the major event risk. I highlighted on Daily FX, and we've been speaking about it here on the webinars, guys, the major thing the Feds will be looking at, or the major concerns that the minutes highlighted yesterday. If we take a minute and talk about that, essentially, it's all the things that we've been talking about here in the webinars. Bear with me one moment. So this is a little piece I put out on Daily FX. I just wanted to kind of cover the fundy part of it, but weakening labor force was the first thing that I wanted to highlight as the major sort of headline that the Fed's is looking at. Keep in mind, dual mandate, maximum employment, price stability. That 38,000 print that we got last month, if that was a fluke, we should see a pretty strong recovery this month. Keep in mind again that unemployment rate was falling as a result of the weaker labor force participation, which is something that you do not want to see, right? As the broader labor force participation contracts, it'll put artificial downward pressure on the unemployment rate. So even if the headline unemployment print tomorrow pops higher, but you get an expansion in the labor force participation, that would still be a benefit, a positive development for the labor markets. So sort of highlighting what the Fed is looking at, what are the major concerns they have is the weakening labor force. Obviously, the impact on Brexit, we haven't really seen a material commentary except for some of the speeches that we've gotten from the Fed officials. Remember, the minutes that we got last night were previous or ahead of the Brexit, so we don't really have the full committee's reaction to that. The economic projections were lowered, remember, as it pertains to growth, more of a cautious approach, and the inflationary picture remains pretty lackluster. They still continue to say that they're going to remain under target for a couple of years. But notice that the first thing is still weakening labor force, which puts more emphasis on tomorrow's release if we're going to get that 180,000 print for the United States. With that said, Mike, that's all good and dandy, but how do we trade it? So heading into the NFP release, I would be looking for a rally in the euro to offer some possible short exposure if we can get back up towards this region, which is again still bullish invalidation, or bearish invalidation, nothing's changed. So on a rally into this region, I would be looking for short entries. Or if we do inevitably break below the weekly opening range low, that key 618, I'd be looking for a subsequent pullback again to press the shorts. If we do break that low, your next subsequent targets aren't until 109.94, basically 110. And then the lower parallels here. And if I bring this into a 4-hour chart, it's a little bit easier to see for the current operative structure. This is just a sliding parallel for the same slope. And that basically takes you to 109.09. Okay, this is next week, all right, on the 13th. But to put things in perspective, this would be a full 100% equal leg down extension off of the highs that we made for the year. Okay, so sort of a big deal here if we do break below this 110.30 level in euro dollar. Any questions on the euro before we move off? Near-term trigger there to keep in mind. So right now, heading into the U.S. session, treat it as a range. I'd be looking for an extreme high of 111.07, a low of 110.60. Look for that break. Broader bias remains weighted to the downside below 111.26. Okay. That is euro dollar. Moving right along from last night, Aussie dollar. Obviously, an interesting reaction. You got S&P downgrading their outlook for the Australian economy. It wasn't necessarily a downgrade, guys, but it was a downgrade outlook to negative. You saw some pretty crazy whipsaw action on the release. Really see the Aussie just plummet off the side, but it recovered rather quickly. Okay, here's the impact of that S&P downgrade. Right, it wasn't even worth a 30-minute candle, which we closed at and quickly started to recover. We actually took out the highs, and we're still sitting in that same range. Here's what the Aussie looked like last night on the 30-minute. Okay, so again, remember our constructive bias was above the weekly and monthly opens, which gives you a range of 74.48 into 74.50. That also today happens to coincide on basic channel support. We're going to continue to favor the long side for Aussie while below this region. Now, when I say that, we're not looking for Aussie to go through the roof yet. Right now, the major premise is to get into the upper parallels. So if we take a little bit of a broader look, let's go to the daily chart real quick. If we take a look at the broader picture here for Aussie, exceptionally clean. And I went over this with you guys yesterday, so I don't want to, again, waste too much time today, but exceptionally clean as far as the median line structures, both on the ascent and the embedded descending median line structure, right? With support, resistance. There's the 50 line. There's that rebound we got yesterday right off that level. There's the upper parallel. And the 618 retracement of the entire decline off the yearly high comes in at 75.75. That median line comes in, to be fair, just ahead of it. Okay, so keep that in mind here heading into the U.S. session. On the 30-minute, the weekly high comes in at 75.44. That's what I was initially targeting. And then just above that, you got the upper median line parallel right around 75.60s right now. So the levels from last night haven't changed, okay? We're right on target as far as the median line being right around 75.60 as of now. A breach there looks for that 75.71, really short-term targets until the April low day close. And this is the big one that you really need to get through to validate a much more concrete break to the upside for the Aussie. Remember, if I zoom this out real quick, this slope that we're working with was derived just off these two reference points a few weeks ago. Okay, support, 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 false break, pivot, resistance. If we take that same slope to this week's or last week's low rather, there again, you caught a really nice rebound. So the April low day close, this is the 2015 April low day close at 75.90, converges on that basic median line or basic channel resistance heading into the U.S. session close today, heading into the Asia Open tomorrow night, or tonight rather, excuse me. So an important level to keep in mind, and certainly if we do get through that, I think you see a lot more upside here in Aussie dollar. That being said, we are simply still trading within the confines of the weekly opening range. Look for this pullback again to find support somewhere around 74.70. It's exactly where the S&P downgrade found support last night. And none of the levels have been changed, guys, since earlier in the week. So we're still working with the same setup. I'd be looking for a long opportunity or long triggers on a run into this region, again, which we'll reserve as our bullish invalidation level. It's funny because these downgrades, guys, I really find it humorous. All of these credit rating agencies. At the end of the day, they're so reactive and not proactive. Even when you remember, guys, during the financial crisis, and we were seeing, all these banks getting downgrades, and the sovereign debt crisis, and all these governments and sovereigns getting downgraded, all reactive, right? None of it's proactive. So it's interesting. Because sometimes it'll have a larger market impact and sometimes it won't. Typically, with something like this, again, you're not going to see it coming, right? So we just want to have our levels mapped out. Luckily, 74.70 was a really nice bounce. I think we got as low as 74.67 before finding a nice rebound here. And again, for a quarter of the daily ATR in Aussie, you're only looking for about 25 pips. We're working about 100 pip ATR right now on a daily basis. So somewhere in the range of 25, 28 pips per scalp should suffice on the Aussie. Questions on Aussie dollar? And just to put things in perspective, there hasn't really been much of a shift as far as what the expectations are from the RBA. Interest rate expectations are pretty anchored here. Here's what they look like. I think we went over this yesterday, but we're still looking at a 54% chance that we'll see the RBA cut next month. As you get deeper into Q3, Q4, that probability just continues to increase. So it's interesting that we're seeing Aussie react in the way it is, despite these expectations. And again, gives you a little bit more confirmation, conviction on the underlying momentum trade. Yes, Eileen. Eileen's saying, let me take a step back. Maybe not to invest, but Eileen is asking, these credit up and downgrades, what are they supposed to do? Warn folks not to invest. They're basically supposed to give you a gauge. They're basically more for an investor protection type of function, right? So before you individual investors, institutional investors, municipalities, before any of these guys start to invest, the credit agencies kind of give you a take on the credit worthiness of the specific asset, whether it's bonds out of sovereigns, whether it's whatever it is that they're rating, right? So the interesting thing in the comments, Eileen, is that they're very reactive. It's not. It's funny because I don't want to get into it now, but we could go back into the financial crisis, and when they downgraded the United States, okay, you saw the dollar tank for like a day, right? And then it ripped like no one's business. So it's funny because you'll see all these banks plummet at the lows, then all of a sudden S&P or one of the other rating agencies will come out and they'll give you a downgrade. Well, thanks. I mean, the stock's down 18% year to date. Why? And you're giving me the downgrade now, right? So I just find it comical. It's not something I really want to take in consideration. And for someone who's long-term investing, sure. From a trading standpoint, it's just noise. All right. So if there are no other questions here on Aussie, let's see if we can find some support on this pullback to offer some fresh long exposure. Again, constructive above weekly and monthly open, 74.48, 74.50. Moving right along. Dollar CAD. Oh, the dollar CAD. Another one that's been very interesting has continued to play out pretty nice. Here is what dollar CAD looked like last night. Just want to highlight a couple of things on the daily chart. We've added some slope to this. If you guys remember a few days ago or yesterday, actually, we were looking at just the consolidation formation here, this triangle that we were playing within. A look at the slope that Jamie's been using looks like it actually pans out pretty well with basic triangle support. So if you take a pitchfork off the low, and this is a modified shift, Okay, if you guys remember, just a quick breakdown. Schiff gives you 50% in time and price. So it'll take literally 50% of the time of the first leg up and 50% in price and angle it as such. A modified Schiff simply uses the slope of basic channel or trendline support. So it'll model it, or it'll shift the slope to match just basic trendline support or resistance. So as it stands right now, if we do that, it looks really interesting that yesterday's high was a perfect tag of the 50 line. Okay, and this is the same slope as basic support. So what that all says is the 50 line now converges on basic trendline support off the low right here, right around the 29 handle. Okay, now into the 30-minute chart is where things get really cool. I know this is a little bit messy here because there's a lot going on, but let me walk you through it. Here's what the 30 looked like this is the hourly, excuse me, on both of them. Here's what the hourly looked like last night. So building divergence into the highs. Okay, this was right after our webinar yesterday. We surged right into that high, trigger break to the downside on building divergence, the pullback. Your initial target's 129.70, 129.40, and here's where we were yesterday. We hadn't tagged the 129.40. And I noted, look, you have that confluence there. You might get a bounce to the upside, but at the end of the day, the focus is lower sub 30.15, which of course is just a swing high from here. Okay, 5.9 and the 6.30 swing high. And the focus remains weighted to the downside while below this region. So you didn't get much of a rebound. It tried to break through the upside, and on this run, on the 5-minute, you actually did get a decent trigger to the downside. This was early in or late in Asia, pre-open for London, and here we are again back at the weekly open, 29.14, monthly open, 29.23, 618 retracement of the advance, right in between at 129.17. Okay, so I'm not interested any longer in short exposure from here. If we do get a dip into this 29 region, maybe even a little bit lower, test that little pivot there near 28.90, I'd actually still be looking for some possible long exposure here for dollar CAD. Okay, just on account of where we are in slope. And if that slope is right, let me bring this out even further. You have not only the 50 line, but basic trendline support off the lows, that lower parallel. And again, that 618 retracement should offer some support here. You also have that 526 swing low. Where is it? That's right here. So there's a lot to look at right in this region to see if dollar CAD holds. If it does continue to hold, again, looking for long triggers into this region on the near term, your top side targets would be unchanged, essentially looking for a rally into basic trendline resistance off of last week's high. Here's what the 30-minute looks like. Okay, and here's just a quick view, guys, for those of you interested in some price action on the near term heading into the U.S. session. Here's what the 5-minute and the 1-minute look like for dollar CAD as well. You know, a couple of things that you want to note on these, and you'll hear Jamie talk about them all the time, raised floors and raised ceilings. You know, on pullbacks and uptrends, when the market turns ahead of support, that's actually a pretty strong indication that the momentum, the underlying push, remains heavily weighted to the upside. Same thing when we're rallying and the rally fizzles out ahead of resistance and turns lower. So every time you tag support, you want to see the pullback find some support ahead of that previous low to give us a little bit more of a tell. So looking at near-term price action, look for some support at 40 to start materialize. Specifically on the 5-minute, look for a push through 60 to begin to at least give us the indication that the downside momentum is waning. And if we get that dip into 129, we'll be looking for the long triggers to get back on this trade. Any questions on dollar CAD? Stephen with a great question. Let me bring that back. He says, when you look at the 1-minute and the 5-minute chart with the 20-period RSI, are you watching both charts to indicate oversold or overbought? or just one of them? So before I answer that question, Stephen, I just want to say one thing. I don't want to put any added emphasis on any oscillator. They're all backwards looking. That being said, for me, Stephen, I just want to see a couple of things. I want to see whether we're showing some basic support or resistance near 40 or 60. Remember, when the market's in a really strong downtrend or when the market's moving lower, you should broadly find resistance at 40, 40, a little bit of smidge here, but resistance at 40. This tells you that the push is still lower. In broader uptrends, I want to find, or in rebounds or in rallies, I want to find some support at, I'm sorry, I was saying 40, at 60, right? In a downtrend, 60 resistance, 60 resistance. In an uptrend, or when the market's reversing, I want to see it blow through 60 and find some support near 40. So I look to see if those tendencies are clearly popping out at me, right, Stephen? The second thing is I do want to see if it's oversold or overbought, specifically on the 1 minute, to give us an indication, again, whether the market might be losing some steam. The more I'm trying to answer your question as much without putting too much reliance on it, Steve. I want to say the thing I'm more paying attention to in RSI is that it's not invalidating something that I'm trying to do. You know what I mean? So, Steve, if we're coming into resistance and the 5-minute chart is in overbought territory, I'll look for the cross below 70. But as long as it's up there, I'm not going to try to fade the trade. Because as we all know, and as we say here time and time again, something can stay overbought for an hour, a session, a day, a month, a week, a year. There's nothing that says it needs to come back from overbought condition. It's the condition of breaking below 70 that's your actual signal. So I look to make sure that the momentum signature on the near term is not invalidating what I'm trying to do, right? If I get a trigger there, that's even better. Now I got the okay. Now I got the get in now. But on a glance, I just want to make sure. Oh, okay. I'm looking to buy. Momentum is not an overbought condition, for example, because I'm not going to buy while we're in overbought. And obviously, the triggers are something that have been a huge part of my personal trading, generally speaking. You're also looking for near-term divergences, which you're getting here. And this is something I was looking at earlier. You're starting to get some near-term divergence right here. Price action's making a lower low. The oscillator is making a higher low, right? And you want to see that start to materialize into more constructive price action. The biggest tell, guys, is very, very basic. You'll start to see a higher high and a higher low. Ideally, you break in near-term resistance, come back and check it as support, and that's your entry against the low. So, Stephen, does that help? I hope I didn't confuse you on anything. It's more to really make sure that what I'm looking at is not something stupid. I'm not looking to buy an overbought market. I'm not looking to sell an oversold market. And obviously the momentum triggers and divergence are our, bread and butter as far as when to execute the trade. So, Stephen, feel free to let me know if that helps. Don't be shy. If there's specific more questions or something you don't get, you're in the right place, man. Just let me know. All right. So 129 on tap. Let's see if we get the dip into that region there, $4 CAD. If we get back above the 50 line here, again, let's see if we can't get that move towards the upper parallels. Moving right along from yesterday, that was the 3 charts on the intraday updates that we'll be following. I do obviously want to cover the rest of the dollar majors as we head into non-farm payrolls tomorrow. Here's the dollar or the euro dollar look like earlier in the week. On the breakdown here from basic channel or an ascending channel formation. Here's what it looks like near term. We went over euro dollar already, but keep that in mind. What was the other one that we wanted to cover? Kiwi dollar, I'm sorry. Kiwi dollar looks like this. There we go. All right. So if you guys recall, earlier in the week, we were working with a bearish bias below the weekly open. This thing opened up the week, rallied into the 786 retracement early on, which was at 72.28. and we saw a downside break, of this ascending channel formation we were in for the majority of last week, right? And it continued pretty well. Now you came into some support here, which offered a little bit of a bounce, but the biggest thing was some comments that we got yesterday, like I said, from Deputy Governor Spencer, talking and really warning about the risks of further rate cuts. Interestingly enough, if you look at New Zealand's overnight index swaps to kind of get a gauge of what market expectations are, you're still looking for an expectation about 64%, 65% that will get a cut next month. Okay, the expectation peaks right into the first quarter of 2017 at 85 and 86% in February and March. But even into the close of this year, high likelihood that we'll see an interest rate cut. Now, whether that cut is, let me take a step back. What I'm trying to tell you guys is it looks like the cut is priced in at this point with a 64%, 70% margin over the next 2 months and Kiwi where it is. I don't think those comments will necessarily have a lasting impact, but certainly we're right back at the range highs. Take a look at what the Kiwi dollar on the daily looks like. It's real ugly. And this is why I kind of been shying away from trading this. So basic channel support, we mirrored that to the high that we made in late last year, specifically in October. It was clean until last month. We came through, rocketed, made a massive outside day reversal on Brexit, and I kind of thought that was going to call it a day. Early this month, again, break to the upside, next day, quick recovery lower. So now at this point, we're not going to stress this any longer. I'm going to get rid of this. We're going to use basic channel or basic trendline support off the low just from this year. Whoop. Okay, and that's sort of what I'd be looking at near term. Now, the other thing that's kind of got me irked here is the 618 retracement of that entire decline. It still comes in at 71.53, which we've been sailing through on both sides. So at this point, I'm not going to want to stress that either. And as I remove some of these lines and clean things up, excuse me guys, lose my voice towards the end of the week, you start to get a little bit more of a gauge of just a near-term consolidation within the confines of price action just off of the highs here. And it's not going to look too good on the daily chart, but you get the picture. All right. So as far as the RBNZ is concerned, excuse me, guys, one sec. I've got to clear my throat. Okay, sorry about that. So we're heading back at the session highs, guys, and this thing is to be treated as a range until we clear it. So I'm actually looking lower from here. You already have a signal that gave out with the break below 70. I would be looking for the pullback. Stay super nimble. You don't want to get aggressive on this because it's simply an opening range that continues to hold. Your major support and the near-term bullish invalidation level is where our bearish invalidation level was yesterday, 7160, 7159. Former trendline resistance, the weekly open, the 50% retracement of this week's range. Very simple setup here. I really am not looking to play anything outside this zone until we either clear it, favoring more of a downside break despite what we saw here in recent price action. All right, so Kiwi dollar still on the sidelines here. I'm going to keep this on the radar charts for now. I haven't really operated on it as of late. Steven with a comment here. Sorry, I missed that. He says, that helps. Oh, you're talking about the RSI conversation. That helps. I was not saying what the simply use the RSI as a buy or sell signal, but how are you using the 1 minute and 5 minute charts in conjunction with one another? I can't say I understand everything you said, but when I know more, I'll ask another question. Thank you. Hey, Steve, you're more than welcome, dude. Look, all I'm saying is that you're not necessarily using them in conjunction. You're just using them both as a reference. I'm not necessarily looking for any type of market reaction or some sort of divergence between what I'm seeing on the two. It's just something I like to gauge real quick. So I'll look at the 5 minute, make sure we're not in major oversold, overbought territory, and then typically I look for like 1 minute triggers to get me into the position. This is just These are just up. I don't even want to stress RSI. These are just up to look at what near-term price action is doing. But how are you using the 1 minute, 5 minute charts? So you're not even talking about the RSI, right? I hear what you're saying. And by the way, this is an indicator that's called trade sessions. You can get it from FXCM codebase.com. I think they also have it on FXCM apps. So this is another thing I use the 5 minute charts for, Stephen. This indicator allows me to visually highlight what the opening range for each session is, right? Now, it's only going to highlight the high and low, so you have to actually derive the opening range. But every session open, the green is London, the blue is Tokyo, the light blue is Sydney, and the red obviously is the US opening range. So for me, excuse me, as the market opens, I kind of wait to see what that opening range looks like. So here's for an example, a perfect example of an opening range break yesterday in US trade in red. Okay, US markets open, you push into a high, first hour of trade, you fail at that high, you push into the high again right around an hour after the open, 9:30, here's the 10:30 failure, a break below the opening range low, shifts the focus lower against the high, looking for a late session low. Next, here's your Tokyo opening range, never broke, right? You did get the spike to the upside, but it quickly failed. You never got a break. London opening range, never really broke, right? In fact, I would have kind of considered this an opening range break to the downside, in which case you've already made a move to the lower part, the latter part of the session. Still got a few hours left on London, but you get the picture. That's another thing that you like to use near-term price action just to see what the tick-by-tick data is telling you. Now, you can get crazy with it and start looking at tick charts, but I highly don't recommend doing that. And one of the things, Stephen, I want to mention is this is just here for reference, right? All the analysis that we do, the levels that we map out are all based on these charts. It's just that when price action is approaching 72.28, or when it's approaching one of those levels, I want to see what's happening in the near term. Are we getting a lot of rebounds or reversals near 60? Are we way overbought condition, looking for that break below 70? Helps you just time the entries a little better. But all the analysis needs to be taken out on a much, much grander time basis. Even as a scalper, even as a near-term trader, when I was sitting on the desk, you can't just have a 2 minute or a 5 minute or a 1 minute chart and just be trading purely off that. Even guys who trade strictly momentum, I get it. If it's a strategy that you've been working with and you love being a momentum trader, that's awesome. But you'll lose sight of major key technical levels that you might be buying into resistance or selling into support. And that's not what you want to do. So we have to have that daily chart as our roadmap. The 30-minute is like our intra-state map where you make a right here, you make a left here, and the 5 minutes just a trigger. Okay, everything looks clear. Let's jump in. So, Stephen, again, as more color comes out, feel free to add any more questions that you have on that. Okay, so commodity block heading into non-farm payrolls. Here's what the gold trade looks like, and certainly losing steam at that major key, huge long-term resistance level that we were talking about yesterday. So again, 2011 all-time record high trendline resistance, a 1618 extension from the advance off last year's low, specifically there in December. And this is the 1618 extension, or the 1618 parallel of this formation that we've been working with off the lows. You can see all of those converged right there. We did close yesterday above. As we were talking in the webinar, we were saying, look, this thing, if it closes above, the first initial resistance level would be 1380. The high that we made yesterday was 1375 before turning around. So right back at former resistance, now support. If we push through this on the downside today, look what's going on in daily momentum. If we break 70 to the downside and we push below this region today, I wouldn't want to be long gold in the near term. Okay, I do think you can see some near-term weakness that takes you right back. If not the monthly open, at least this sliding parallel here. If we close above it, unchanged, guys, you're looking for 1380 and above. So a lot of this, I think, will have to do with what we see tomorrow in non-farm payrolls. If the dollar does rally, I would expect this to be a false break scenario. You'd start to see some pullback. But all things held constant, you don't have any divergence into this highs of magnitude on the longer term daily chart here. And with the dollar seasonality weakness that you'd expect to see, as we talked about earlier in the week, seasonalities drop off pretty early in July. That should fuel or at least put a floor on the gold trade. So long story short, if you're holding gold longs, a break below 1357 on a daily basis would have me concerned. If you're looking for fresh dollar long exposure, long entries, I'd be looking for a move back towards that median line, targeting, like I said, 1380 channel resistance, and ultimately that 828 high from 2013. And that takes you into 1344. Steven says, great, thank you. Hey, we're more than welcome, Steven. And again, as these questions come, don't hold anything back. Feel free. Eileen says, great discussion. Thanks, Steve. Just think, guys, there's always someone in the room who probably has the same question you do. So I want to keep this as lax as possible. Whatever you guys want to talk about, we're here. A quick reminder to everyone in the room. Also, Jamie's midweek strategy webinar is on tap later this afternoon, 1 p.m. Eastern, as we push that back from yesterday's FOMC minutes. By the way, dollar CAD making a move right now. Let's take a look right back at that 30-minute. Coming in some support on the daily. Coming into support on the 30-minute. Okay, so here's an example of how we use this in live time. If we find some support along this trend line on the 5-minute, that would be ongoing divergence with a third divergent signal to the downside as the oscillator is making a third higher low. And then within the confines of that, now you also have a topside trigger, something like this. All right, so you have a trigger on the 1-minute to the upside, you have some support that you want to look for the 5-minute on the decline, and you have a level mapped out clearly on the 30-minute chart. If we get those triggers all lining up, I think this would be a decent trade. If, by the way, this thing opens up the US session and just plummets through, don't try to fade it. Below 129, I do think it can drop down to 128.46, and that's a 50 pip drop. Not something I'm willing to wager here for dollar CAD, but looks pretty good on its initial touch here. So we'll see if we can't get some upside rebound on dollar CAD. Steven, does that put some more color to it? All right. So we went over gold. Watch for that false break scenario. Today's close will be paramount in gold. The other trade that's going to gather more attention as we get deeper into July trade is definitely crude. And it's interesting. We might as well take a look at crude while we're looking at dollar CAD. Here's what the crude trade looks like. First on the daily chart. We talked about this yesterday, and we talked about the fact that the range in crude is simply defined still till this day by the May open. So the May open was the opening range also for May trade. Okay, we broke that on the 12th of May, giving us an upside bias looking for a late month high, which we got. Last month was a wash. We never cleared the opening range. And the lows for the month continue to be the May open, which is still the opening range low for this month. So even into yesterday's trade, guys, if you remember, we were saying don't be surprised to see this thing pop higher. We want to stay bearish below the monthly open. Bearish invalidation is going to be that trend line, and we'll be looking to see if we can't get that downside break. Inevitably for a move lower here into 44.68, which is an exact equal leg 100% extension off the high. So price action for crude is actually not that. Well, let me take a step back. It's actually clean. It's just that the near-term momentum continues to be lackluster, right? So we could spend a couple more days consolidating. Typically, if you have these triangle formations, you'll see a break 20 to 30% or 10 to 20%, excuse me, into the apex is when you'll see that breakout start to materialize. But we're at long story short, we're coming off of the upper median line, parallel resistance. Again, range support for the last 3 weeks. Last 4 weeks continues to be that 46 handle, and key support would be 44.68 with a break there, really suggesting you have a more prominent high in place near term. Does that make sense? Really clear levels here on crude, excuse me. So near term, long story short, I'm looking for this rally to fizzle out near the monthly open, which is right here at 48.40. Again, last ditch effort for resistance should be that trendline resistance off last month's high. Yes, Steven says, yes, that was great. Cheers, man. He said, I had dollar CAD 1 and 5 minute charts pulled up. I was watching it this morning, and then to have you pull it up as well was awesome. Although I need to study divergence a little more. So I can't clear my throat enough today. So divergence, Steven, is one of the most profound things in momentum. More than overbought, more than oversold is the divergent signal. And the most important thing, I don't want to waste everyone's time here in the room, but I just want to recap it for Steve. The most important thing, man, is that you're looking for an extreme in price to not be reflected in the oscillator. It's very important you take my words here literal. So you're looking for an extreme in price to not be reflected in the oscillator, not vice versa. Meaning a new low in price and you don't see that extreme in the oscillator. Now, when it's a higher low, that's a stronger signal. But even if it was an equal low in the oscillator and a lower low in price, that's still divergence. Okay. One other thing, Steve, that you want to keep in mind is that the closer the divergent signals are to the 50 line, in fact, the stronger the signal becomes. So if both of my divergent points are like way below 30 or way above 70, those are typically so weak I won't even give them credence. But if the divergent signals are closer to 50 or one of them is below the extreme and one of them is above 30, these tend to be some pretty decent signals. Okay, so keep that in mind. One other last note I'll say, when you're looking at a daily chart, Steven, divergence can last for days, weeks, doesn't necessarily give you any reference on time. Okay, so when you see a divergent signal, a lot of traders will get really excited and start, okay, let's fade the move. Not the right move, right? Near-term price action still needs to validate what we're seeing. And so for an example, if I bring this back, right, we're still getting divergence on that 5 minute. Remember, all oscillators, whether it's RSI, stochastics, CCI, all of them are based on the candle close. So this line means nothing until this 5 minute candle closes. This line means nothing until this 1 minute candle closes. So before you make any assertions of overbought, oversold divergence, we need to keep that in mind. This is a perfect example of a trade that you're an oversold now. So for me, I'm not going to try to fade that yet. Right, Steve? Because it could stay down here for the next 10 minutes and I'll lose another 15 pips on the downside. Not my way of trading. But once we get across above 30, and specifically if we get the trigger break, and you have some divergence on the 5 minute, well, now it starts to look more appetizing. So some food for thought there, Steve, on a basic divergence breakdown. Okay, any subsequent questions on the dollar setups that we covered today? Euro, Aussie, CAD, Sterling. I don't want to encourage you guys to necessarily fight Sterling here, but I do want to just highlight that key region of support that we highlighted yesterday. Boy, did it hold. That was at 128, basically 127.97. Guys, we're at 130. We got a 200 pip rally off that key region. Again, I'm not involved in it. I don't want to encourage you guys to start trying to fade this move, but I do want to say this was huge. Okay, for those of you who weren't here with us yesterday, just a quick review. This is a basic 786 retracement of the 1983. 1984 low. Don't want to give you misquotes here. 27.97, but it also converged on so much stuff. Okay, I guess you still have to keep it into a weekly chart to get a view of it. But basic trendline support off the 1993 and 2001 lows converged there. If you take slope support, extending off these, so basic resistance, take that parallel to the lows. You can see some nice plays around here. Take that parallel to the lows. Look where it converges. So 1985 slope also converging on that region. So we're not saying it's a full reversal. We're not saying this is where sterling is going to bottom, but it might be enough for a pause, maybe a little bit of a rebound before we break lower. I do expect we could see some further lows here in pound, but you know, with the technicals are where they are, we're not going to succumb to all the headlines and news media. We're going to look at what price action's saying. Right now, price action's saying, hold up. All right, hold up if you're short. You got divergence, you got momentum looking like it wants to break on a daily basis back above 30. So we're going to want to see that on a daily close basis. But even in near-term price action, starting to look a little constructive. Here's what it looks like on the 30-minute chart. Obviously, there's your Brexit drop-off. And here's what we look like since last week, right? All these on the 30-minute charts, on my charts, guys, all the vertical breaks are your weekly opens. So basic weekly opening range break gave out, downside bias, cleared right back above a basic sliding parallel. This is just a parallel of the same slope of resistance. Here we are to the upside. Momentum looks pretty constructive. Got a couple of bounces in overnight right off 40. This is your first 60 break that you've seen since the start of the week of magnitude. So I do think you could, dare I say, if I start saying this on Twitter, I'm sure I'll get tarred and feathered across the internet, but dare I say, near term, it does look to me like you can stay at least on a scalp basis constructive above somewhere around 29.40, 29.38, this low from last night's Asia session, and look for a possible push into the 50% retracement, which lines up pretty nicely with those lows we made last week or thereabouts. One other thing that's just kind of eyeing me down. Give me 1 sec. I just want to see what this looks like. Oops. No, it's not so bad either. 130.90 as an initial topside region of possible interest. All right. So quick look there for a near term on pound sterling. Again, a quick reminder to everyone in the room, you can take a snapshot of these charts if you need them by clicking on that camera button in the top right-hand corner. Okay, two other things I want to go through real quick. I got 7 minutes left. I do want to just touch base on an interesting trade that me and Jamie were looking at. Aussie CAD off of a big region and a big reversal. Okay, for those of you who have been with SB Trade Desk for over a year, you're going to remember this chart quite vividly. We were talking about this slope of influence for Aussie Kiwi for literally over a year. It derived from the 2014 lows and the subsequent lows that we made towards the latter part of the year, and the initial opening range high for 2015 is when we started to take note of this incredible slope that has continued to define so many major turns in Aussie Kiwi since 2014. So you can see here that same slope, resistance later in the year, heading into May, resistance, June, resistance, breakthrough. Next following 4 months saw this thing test as support, 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 before finally breaking down in October. Okay, a little bit of a squiggle here on the rally back in November, a little bit of squiggle here to open up this year, but take that same slope, extrapolate it down to the lows that we made October of last year. Nice touches. Take that same slope, extrapolate it to the lows that we made last year for the actual yearly lows, look where we came off here. Okay, absolutely incredible. And when you see this stuff, I mean, you can't make this stuff up. It's important to take note of because it can really be beneficial and helpful in helping us identify when the trend is vulnerable and when it's not. So, as it stands, the initial reaction that we got was phenomenal, right? And I didn't really want to get involved in scalping this per se because you're having some divergence in what you're seeing happening in Aussie and Kiwi, but they've broadly been moving in lockstep with what's happening with broader risk. You saw that initial Aussie rally and the Kiwi hold really smack this thing higher and give us a perfect rebound for the monthly low coming off this key region. Note that a basic 764 retracement off of the 2015 low comes in at 103.53. The low was 103.63, 10 pips off before ratcheting a huge rally into 105.50. So what does this mean today? Honestly, it gives me room for pause. It is an outside day reversal. Typically, these are pretty bearish developments. While we didn't come off slope resistance, we did come off basic highs and a swing high that we made there, specifically on June 15th. Okay, and the swing low that you made for January, which was the yearly opening range low. So for me, these are the battlegrounds and these are the levels we need to keep in mind moving forward. If this thing clears this descending channel formation, this descending median line formation, I think you can be in store for a really nice longer term play long here in Aussie Key. Okay, and with the same respect, if this sucker gives out right here, sayonara. There's really nothing up on tap until bring up an 88.6 here, but wouldn't expect too much craziness there. I'm basically looking at 101.80. Okay, and interestingly enough, last year's low day close would also be on the menu. Right here at 10060, basically. All right, so this daily chart is very ominous. It does highlight a major critical range that we want to pay attention to. I'm going to reserve this as the monthly July opening range, either a break below 103.50 or a breach above 105.40. Until then, treat it as such. And we should get a little bit more of a clear breakout trade here, I think, over the next couple of days to finally give us a little bit more of a conviction bias here on Aussie Key. But real critical levels. Okay, and the final thing I did want to go over with you guys is Euro Pound. Obviously, we've been looking at that as well. Here's what the Euro Pound daily chart looks like. The breakout did materialize, and I think it's validated at this point. You want to stay constructive above 83.70, inevitably looking for a stretch into 87.09. So again, nice confluence of the 50% retracement, some basic trend lines and median lines off the high, former median line resistance, all converging again right here. Inevitably looking for a stretch into 87. Not a scalp per se or intraday, but certainly I think warrants paying attention to on just the basis of the technical clarity we're seeing here. All right, that's as fast as I could talk and as much as I could get through in an hour. So I hope that helps. Guys, don't forget you have Jamie on tap at 1 p.m. Eastern to go over the midweek strategy webinar. We'll pick things up on our public webinar on daily effects. I know, Eileen, I talk a little too fast. We'll pick things up on Monday for the public webinar on daily effects at 8:30 Eastern, and then back here Tuesday, Wednesday, and Thursday of next week. Best of luck trading, guys, and have a great weekend. Cheers.